Welcome, everyone. Thank you so much for joining us today. We appreciate you being here because we know that this program is entirely optional and you are honoring us with your valuable time. So, just a quick reminder that the information in this presentation is intended for informational purposes only and is not intended to provide legal or financial advice. As always, we recommend you review the requirements in your region with the broker or the manager in the office that you're affiliated with, especially those related to contacting the consumer. And please consult with the appropriate advisor when dealing with any issues you may have with specific files or clients. And with that, let's go ahead and get started.
All right. Hello, everyone. My name is Jillian Rosansky. I am one of our senior exchange advisors here at Real 1031. And then, as was briefly discussed, we are affiliated with the Anywhere family of brands. So we work a lot with, Coldwell Banker offices, Guardian Title offices, and, any other brands that are also affiliated with the Anywhere network. A little bit about me. I love speaking about anything and everything 1031 exchanges. I'm third generation in my family for 1031 exchanges. My grandfather was in the industry. He's now retired. My father's actually still in the industry out of California. But it's something I really enjoy doing, helping people, save money on their taxes and being able to meet their estate planning goals. So I'm really excited to speak with y'all about everything and anything regarding 1031 exchanges. This is a great overview course, especially since a lot of you are new to Section 1031. With that being said, I will let David go ahead and introduce himself as well.
Thank you, Jillian. I'm not third generation in 1031 exchanges, but I am third generation in investment real estate. My wife and I are both third generation real estate investors. I'm a recovering attorney here in New Jersey. I practiced law for about a dozen years, doing a lot of business and real estate transactional work. And I've now been a full-time qualified intermediary for coming up on 25 years. And like Jillian, I very much enjoy speaking about anything and everything 1031 exchange. I've been at more than one conference where somebody has whispered in my ear, the next speaker canceled or got sick or didn't show up. Can you go fill an hour? So yeah, I can. Happy to see you all. Look forward to working with you.
Absolutely. And then I will be presenting the first half of the slides, and then David will be presenting the second half. So I'm going to go ahead and get started. And we're going to go into objectives. But before I get into the objectives, I'm going to talk a little bit about why this is so important for you as realtors to understand or be knowledgeable about. I speak with a lot of realtors, residential realtors, as well as commercial brokers. But when it comes to the residential side, which I assume most of you are, if not, let me know, there's a huge reason why 1031s are so important to learn about. So we're going to talk about the process and how it works and why they're important. But the real thing is that if you have a client that's selling an investment property and they are maybe looking into other investment properties to purchase, not only can they defer their taxes through a 1031 exchange, but then you can also be the representative on both sides of the transaction. So if you can identify, investment clients or clients that are, maybe looking at a high tax liability, you can potentially get them to do a 1031 exchange or let them know about the option. And now you can be on both sides of the transaction. And you also will have a dedicated buyer because they only have 45 days to identify potential replacement properties and 6 months to actually purchase. So it's kind of a win-win situation. They get to save on their taxes and you get to have more money as a real estate agent. Okay, so we're going to talk about, like I said, the mechanics of a 1031 exchange, the process from start to finish, some steps and time restrictions, as well as just some things that I think you should know. Okay. All right, taxation 101. So generally, all income is taxable unless it's specifically exempted by law. Even illegal income or income that might not be, stated on your tax returns is still technically taxable. So that being said, we're going to go into the definition of like kind under Section 1031. Now, I'm not going to read this to you because I don't want to bore you or make you fall asleep, because I know I would. So to put this into perspective, if you have a client that is selling what's called a real property interest, so any piece of real estate that's held for business or investment use. For example, if it's a residential property, maybe it's being rented out, or maybe it's being used for some sort of business. And they are also wanting to purchase a property that's also a piece of real estate held for business or investment use. Maybe it's a rental or it's held for business. They can use Section 1031 to defer their taxes. Now, when I say defer taxes, I mean that the tax basis in the property they're selling becomes the tax basis in the property they're purchasing, with some adjustments, and taxes just roll over until they ultimately sell that replacement property. So they don't have to pay the taxes with doing a 1031 exchange, but if they sell the property that they exchanged into without doing another 1031, they would ultimately have to pay the taxes. Okay. So one of the great things here is that you can do as many 1031 exchanges as you like. So we have clients that will what we call swap until they drop. So they will 1031 exchange over and over and over again until they ultimately pass away. And the property would be transferred on what's called a stepped up basis at the fair market value, and it would ultimately be tax-free to their heirs. So that's why this is such a great estate planning tool. Now, we also see clients who would do an exchange until they retire, or do multiple until they retire, and are in a lower tax bracket, so that when they sell, the liability will not be as high. Okay. Now, a couple things I want you to notice or to note with like kind in this definition is that it's really not set in stone. So I have a lot of real estate agents ask me, okay, well, how long do you have to hold a property for, as you know, as a use in a trade or for business or investment, in order for it to qualify? Now, the general rule of thumb that we will suggest is 2 years, or 2 tax reporting periods, that the property is held as an investment or for business, but that's not always the case. And to give you an example, we had a client with a property that they had held for just a couple of months, and then an unforeseen circumstance came up. There was a flood in the entire neighborhood, where the client ultimately had to sell their property after 3 months. And they were still able to do an exchange, because in this case, they had listed it on rental sites and they had intended to rent the property out. But because of an unforeseen circumstance, a flood, a fire, a divorce, they were forced to sell. They got an offer they could not refuse. So if you're curious, just reach out to us. But it really comes down to the client and their tax advisor and what they're comfortable with. Okay. All right, so as I stated, a 1031 exchange is a tax deferral. So you're not getting rid of the taxes, they're just being pushed into the property that you purchase until you ultimately sell without doing another 1031 exchange. But to give you an example of the type of taxes you're looking at deferring, there are 4 different levels of taxation. So the first level is going to be depreciation recapture. So depreciation recapture is any depreciation that's been taken on your tax returns over however many years you've held the property will be taxed back at 25% upon sale. Next tax is federal capital gain, which is anywhere from 15 to 20%, depending on the income bracket that you are in. State income taxes, some states have 0, some states have 13.3%, like my lovely hometown of California. I'm now located out in Colorado, which does not have 13.3%, but I think it's still around 5 to 6%. And then lastly, there is what we call the net investment income tax, which is only valid if you meet a certain income threshold, but that is another 3.8%. So overall, I generally tell my clients that you're looking at between 30 and 40% to be taxed if you do not do a 1031 exchange. Okay. All right, so to give you an example and really put this into perspective, we have an example of a sale and an example of an exchange. Same numbers, but you'll see the difference. So on the left side, you can see that we have a client that is selling a property for $900,000. Now, in a 1031 exchange, you can take out what's called allowable closing expenses, so realtor fees and commissions, things that you would charge. In this case, we've got about $80,000 of sales expenses related to the sale. Now, you can also see that upon sale, the client will have taxes due of about $177,000. And this is based on about $500,000 of gain, assuming they purchase the property or their tax basis is around 400 grand. So if we look at the bottom here, you can see that their reinvestment value is going to be about $642,000 that they can reinvest into whatever they're looking to reinvest into, a new property. It does not matter. Now, on the right side, you can see that the numbers are exactly the same. We've got that $900,000 sales price, $80,000 in allowable expenses, but they don't have to pay that $177,000 in taxes because they're setting up what's called a 1031 exchange. And if you take a look at the bottom, because of this, they are able to reinvest almost $200,000 more into eligible real estate. Now, think about this and think about the fact that most of our clients do many 1031 exchanges before they ultimately, transfer whatever properties to their heirs upon passing. With the compounding, I mean, it's a huge amount that they're now able to reinvest into much higher value real estate than if they had to pay the taxes. I mean, we've got clients that are looking at, $1 million plus in gains taxes that they would have to pay upon sale if they didn't do a 1031 exchange. So it's a huge way to, help these clients plan for their estate and increase their wealth overall. Okay. Now I'm going to stop because I do see a question, and I'm just going to address it very quickly. I have a situation where a seller is a trust and wants to exchange only half of the proceeds and gift the other half to a relative. Is this allowed? Well, that's a great question, Scott, and it leads me into my next point. So in a 1031 exchange, in order to defer 100% of your gains taxes, you have to reinvest your entire sales price less allowable closing expenses. So not only do you have to reinvest all of the net equity from the sale, but you also have to reinvest any debt that's being paid off with new debt, new cash, or a combination of both. So to give you an example, if I'm selling a property for $1 million and I'm paying off a loan of $200,000, I have to not only reinvest the $800 in equity, but I also have to replace the value of that $200 in debt with a new loan, new cash, or a combination of the two. So in this scenario, Scott, if they're only going to put half of the proceeds in the exchange, then they would be taxed upon the remainder. And it may or may not make sense depending on what type of gain they're looking at and their tax basis. So I would recommend having them speak with a tax advisor, see if it still makes sense to do the exchange depending on what their tax basis is. Okay. All right. Just discuss this equal or greater value. Like I said, it's generally the entire sales price less allowable closing costs, and that's made up of both the net equity that's being reinvested and the debt that also has to be reinvested. Now you can purchase multiple properties. So maybe with that $1 million property I'm selling, I found a property I love for $600. I can purchase an additional property for $400 to make up that full exchange value. Okay. And then there are a couple different types of what we call boot. If you don't reinvest the mortgage value, that's called mortgage boot. If you don't reinvest all of the equity, that's called cash boot. But all you need to know is that boot means the value that is going to be taxable. Okay. Bailey, how do commercial property 1031 exchanges differ from residential, if it does at all? They don't differ at all. It is the same exact process. Again, it just has to be held for business or investment to qualify, and most commercial properties do qualify. I'd say about 30% end up doing exchanges. Okay. But you can sell, for example, a residential rental, and you can purchase into any type of commercial property as long as it's investment. Now, moving on with that thought, what is considered like kind? So as I discussed earlier, a like kind property has to be sufficiently held for business or investment use, and it has to be real estate. So some examples of like kind property would be a residential rental, an apartment building, commercial property. Bare land is kind of an outlier because even though it's sitting bare and there's technically no income being received from bare land, it still does qualify for a Section 1031. So you can sell land and purchase a residential rental property. Now, some more uncommon types of like-kind property that are exchange eligible would be conservation easements, airplane hangar leases, wind and solar leases, and mineral rights are also 1031 exchange eligible. There are many more, but I'm not going to go through all of them. Can you elaborate on transferring to heirs? Will that be taxed? So to elaborate, we have clients that will 1031 over and over again until they ultimately pass away, and whatever property that they have exchanged into or properties, they transfer upon the time of death to their heirs at what's called a stepped up basis. So what that means is the property transfers at the fair market value at the time it's being transferred. So there are no taxes to be due because they don't have any gain at the time that it's transferred. It's the fair market value. So ultimately, any heirs are getting the property completely tax-free. Now, if they continue to hold that property for another 10 years after it's transferred, there will be some gain that's accrued. But at the time of transfer, there is no gain. Okay? So any gain that has been accrued, there could have been $500,000 in gain that this client had deferred over the years, that is not going to be taxable upon time of transfer. Okay. All right. So going into the process of a Section 1031 exchange, now I really like this graphic because it goes into detail on the process. But this is, and let me take a look at this. This is a very ideal process. The client selects their qualified intermediary, which would be us, the company that processes the exchange. And then, they list their property. But in reality, how this process works is client will come to us anytime before they sell their property, as long as it's before the date of closing. You can come to us as early, as long as it's at least 48 hours prior to closing on the sale. That's what we would generally prefer. But if it is later than that and you're at the closing table, we can still handle it. Okay. So I will advise the client on the 1031 process. If they have questions, I will answer them at this time. And once there is a written and signed contract for the sale, that is when we get involved. So what happens then is I will request a couple pieces of information. I will request a signed copy of the agreement, as well as title company information, so that I can gather and verify the way that the property being sold is titled or held. Now, once I receive that information, I assign the exchange to one of our dedicated exchange officers. So the exchange officer will work with your client, or you, if you're the one doing the exchange. They will send out documents through our software, and they will work with your closing agent to make sure that everything is set up prior to the date of closing. Keep in mind that a 1031 exchange has to be set up prior to closing on the sale. We get clients all the time that will come to us an hour after closing, 24 hours after closing, week after closing, and there's nothing we can do, unfortunately, if the sale has already closed and funds have already been received. Okay, so once the closing occurs, funds are sent to us as the qualified intermediary, and we hold those funds in a qualified bank account tied to either the client's social security number or EIN number if it's held in an LLC or a trust, for example. And that is when the timelines start for the client. So they have 45 days from the date of closing on their sale to identify potential replacement properties. What I mean by identify is we will send them a form that they can fill out and list properties that they intend to purchase. Okay. Now, they also have 180 days to purchase any properties that have been identified. So once they are under contract on the purchase and they close on the purchase, the funds from the sale that we are holding as the third party are used to fund the purchase. Now, some of you might be asking, why do we have to hold the funds? And if you are asking that, it's a great question. And the reason we have to hold the funds as the qualified intermediary is because the IRS states that in a 1031 exchange, the exchanger cannot have what's called actual or constructive receipt of any exchange funds. It has to be a true exchange of properties. So if the client were to receive funds or put funds in a bank account from the sale, the IRS would see that most likely as constructive or actual receipt of funds, and their exchange would no longer be valid. So we have to hold the funds. We don't touch those funds until the client purchases their replacement property. Okay. Let's see. Looks like we've got two other questions. So the heir can sell at that time and not pay taxes. That's correct, Stacy. If it's transferred on the stepped up basis, they would not have to pay the taxes that were deferred with the 1031. So their state capital gains, federal capital gains, all of those taxes. And does the it is an exchange 1031 transaction need to place on the remark of the listing? So that's a good question. As realtors, you can add what is called the cooperation clause to your contracts if you would like. It's not required, but it is, good practice. Basically states that your client, your seller, will be doing a 1031 exchange, and that all parties agree to cooperate with that aspect of the transaction. Yes. All right. So I am going to go ahead and trade it off. I believe this is where David takes over. So David, feel free to take over from now. And it was great speaking to you all.
Excuse me. Thank you very much, Jillian. Excuse me. Bear with me, if you will, folks. I had a cold last week. I'm just coming out from under it, so my voice sometimes gets a little wonky. So as Jillian was pointing out, the exchange time limits, the statute was amended back in 1984 to include these time limits, because prior to that, there was no specifically articulated time within which an exchange must be completed. And in fact, for most of the time between 1923, when we got the first deferral statute, and 1984, it was believed that exchanges needed to be a true swap, that Jillian and I would need to show up at a closing table and hand one another deeds. The problem with that is that maybe Jillian wanted my property, but I didn't want the one that Jillian had. So there were all kinds of complicated machinations that attorneys and brokers came up with to satisfy all of this. But ultimately, Congress recognized that we need to have some guidance on what is called a delayed exchange. So from the day we sell the property, let's say we go to closing today, January 14th, our taxpayer would have until 45 days after today, so today is day 0, to identify a short list of potential properties. And we'll talk about identification in a moment. The taxpayer would then have a total of up to 180 days, or the due date of their tax return, whichever comes first, to complete the exchange. Now, here we are in January, so your tax return for right now isn't due until April of next year. But if you sold your relinquished property, for example, on December 15th, your 45 days would be the end of January, your 180 days would be in June. You would need to either file for an extension on your tax return or complete your 1031 exchange before April 15th. You cannot request an extension on your 1031 exchange. It is important also to note that it's 45 calendar days, not business days, 180 calendar days, not business days. So if either of those deadlines occurs on a Saturday or Sunday or holiday, it behooves the taxpayer to complete the exchange or the identification on the business day prior. I also want to point out two little things with regard to the numbers. I've heard people say 45 days plus 135 days. I don't like saying it that way because if the taxpayer identified early, they might think they only have the remaining 135 days. And I also caution that it's 180 days, not 6 months. Those numbers don't always line up with one another. So be careful to quote the statute accurately: 45 days to identify, 180 to complete the purchase. Next slide, if you will, please, Jillian. Okay. This is sort of similar to what Jillian showed a moment or two ago, but it's a more linear depiction of what I just said. Today we go to closing is day 0. Day 45 is the day by which we must identify our replacement property. And day 180 is the day by which we must complete the acquisition of one or more of those identified properties. So we'll go into more detail on the next couple of slides. Okay, so what does it mean to identify? Well, the identification must be in writing and signed by the taxpayer. It must also be delivered to the qualified intermediary or the seller of the replacement property. Candidly, if you deliver your identification to the seller of the replacement property, you need to ultimately give it over to the qualified intermediary anyway, because there are some rather technical restrictions on how and when the intermediary can release those exchange funds. So absent the identification, they don't have permission to release the exchange funds. The properties must also be unambiguously described. For the most part, the identifications we receive include a street address, right? 123 Main Street, Boise, Idaho. You know, anybody in Boise can find that property. But sometimes the properties are not necessarily in a big town like Boise or Spokane or Miami, and it might be in a rural area where there's a legal description. So it can be a tax identification number or a property identification number or some other legal description that also works. Additionally, you can use a distinguishable name. The example in the regulations says the Mayfair apartment building. I amended this to say Madison Square Garden because I think we've all heard of Madison Square Garden, but you could say the Staples Center or the John Hancock Tower. It's got to be a property. The description must be such that somebody in that community would understand what property we are talking about. One other point to make is that during the 45 days, our taxpayer can amend or revoke their identification. We've had taxpayers who are insistent on submitting their designation on day 10, and that's fine. They have 35 more days within which they can change their mind. But whatever we have in our possession at midnight on day 45 is the list from which we will monitor the exchange moving forward. Okay, next, if you will. So, how many properties can we identify? I've heard people say, well, I have to identify 3. I can't find 3. You don't have to identify 3. You can identify 3. The point here is that the IRS has given us some leeway. If you're reasonably certain you want to acquire 123 Main Street, that's wonderful. But I think we all know that every once in a while, a transaction will fall through. The inspection came up and found mold that can't be remediated in time. There's a cloud on title that can't be remediated on time. There's an encroachment from a neighbor's property that can't be remediated in time. So those kinds of things could certainly give rise to a need to delay a transaction. So the idea here is taxpayer can identify up to 3 properties of any value, and that would satisfy rule number 1. Sometimes people want to identify 3 properties so that they can acquire 3 properties. That would go well in the idea of the estate planning that Jillian mentioned earlier. Also, sometimes somebody might want to identify more than 3 properties because they're looking to diversify their portfolio. I can imagine a taxpayer who has been exchanging and exchanging and exchanging, and each time they exchange, they buy a bigger and a bigger and a bigger property, and they wake up one day and they realize that a huge percentage of their investment portfolio is tied into one piece of real estate, and they want to start diversifying. So they could sell, and I had this just a few years ago. My client sold a 1/2 interest in a very large industrial property in Virginia, and he identified and acquired 15 condos in the Boston metro. The 15 condos that he bought essentially became student housing for the grad students at Harvard and MIT, because those were the kinds of properties he identified. So 15 is certainly more than 3. So if we identify more than 3, the second rule says you need to constrain your list to not more than double the value of what you sold. So if we sold a $100,000 property and we're identifying 4 replacements, those 4 should not exceed a total of $200,000 in value. Again, sometimes taxpayers violate that second rule, so the IRS gave us a third catch-all. And the third catch-all says if you violate the first rule by identifying more than 3 properties, and you identify the second rule by identifying properties that aggregate to more than double the value of what you sold, then you must actually acquire 95% of the value that was identified. And for both the 200% rule and the 95% rule, the value was determined as of the date of identification. The problem here is that the taxpayer isn't going to be called upon to prove these numbers until they get audited 2 or 3 years from now. So my question to you is, how am I going to prove the value of 123 Main Street, Boise, Idaho in January of 2022? It's going to be rather difficult to prove that value. So what I suggest to my clients who are using the second or the third rules here is that they take a screenshot of the listing from Realtor.com or Coldwell Banker or whatever website they found the property. And that will show me that as of today, January 14th, 2025, right? Because my screenshot's going to show the date stamp in the corner. And it's going to show here's 123 Main Street being offered by the wonderful real estate broker, Jillian Rosansky. And she's got these wonderful pictures. And the asking price is $275,500. Wonderful. I can now validate that that's what the price of this property was when I identified it in January of 2025, if I'm called upon to prove it at some point in the future. So there's a little practice tip for you to keep in mind if your clients are going to be using the second or the third rules. Grab screenshots from the MLS or from your website to validate what the price was as of the date of identification. They may need it in the future. I tell them to do it themselves and keep it in their files. You'll be doing them a solid by doing so as well. Okay, next slide. All right. If we were to take all of 1031 exchange basics and condense it to one slide, that would be this one. This is mostly a recap of everything that Jillian has just said, plus what I talked about for the last couple of minutes. In order to fully defer all of the capital gains and the depreciation recapture taxes, our taxpayers should receive only like-kind property. And as Jillian pointed out, like kind does not mean condo for condo. It means real estate for real estate. So our taxpayers should receive only investment real estate. They need to adhere to the 45 and 180-day time limits. They should reinvest in property of equal or greater value to what they disposed of. They will roll all of the equity from the sale into the purchase, and they will replace debt from the old property. Now, they can replace debt with cash or new debt, but they can't replace cash with debt. So the simple example here I give for these three bullets in the middle is if I sold a property for $100,000 and paid off a $20,000 note, $80,000 of my money went over to the QI. And now I go out and I identify a replacement property for $120,000, and my favorite lender just agreed to finance half of the purchase. That's fantastic. So the lender sends $60,000 to closing, I send $60,000 to closing, and I've just traded equal or up in value, but I have $20,000 left over in the exchange account. As Jillian pointed out, that would be called cash boot. I don't care whether you call it cash boot or just excess funds. The point is, it becomes a taxable event. So it's imperative that they spend all of their cash. We'll talk about some refinancing issues in a moment. And then also, as Jillian pointed out, they need to avoid constructive receipt of the money. They should be using a qualified intermediary to ensure that all of this is done properly, because the qualified intermediary also has to prepare legal documents. It's not necessarily just holding the money. I can't give my money at the closing table to my best buddy and say, here, hold this for me. That's not enough. Next slide, if you will, please, Jillian. Okay, so there are times when a taxpayer will want to sell multiple properties and buy fewer, or they'll want to sell one or two and diversify out into multiple properties, or sells multiple properties to buy different multiple properties, and that all works. You can do that, but our time lines start on the first sale. We must complete our identification within 45 days after the transfer of the first property, and we must complete the purchase of all replacement properties within 180 days after the sale of the first property. And I've seen taxpayers sell 3 or 4 or 5 properties over the course of several weeks and buy 3 or 4 or 5 more properties over the course of several weeks, and that's fine as long as we can get it all done within 180 days. Every once in a while, based on the timing of what's going on, we may suggest to a taxpayer that they break this out into 2 exchanges or 3 exchanges, depending on what's going on. And there's a variety of reasons to do so, including giving them flexibility to buy more properties, to take advantage of the full 180 days. Because if I'm selling property number 1 on January 15th, and I'm not selling property number 2 until May 15th, and I'm going to be buying 2 properties that are roughly equivalent to the values of what I've just sold, then let's set up a second transaction for that property on May 15th, just to allow for more time to complete the purchases of that replacement property. Look, it's entirely possible that both replacement properties are already under contract, and my concern is not necessary. But it's an option that we like to keep on the table for our taxpayers. Next slide, please. Okay. This is something that becomes a bit of a frustration for taxpayers because they just don't understand it. The IRS requires that the same taxpayer who sold the first property be the taxpayer who bought the new property. And this manifests itself in several different ways. Tommy taxpayer sells his relinquished property that he owns in his own name, and now he's married, and spouse wants to be on title on the replacement property. As a general rule, that will not work because Tommy owned the first property in his own individual name. We cannot bring a spouse onto title because that would dilute Tommy's investment in the new property. Even though they are filing a joint marital tax return, the IRS does not like that strategy. Now, Tommy and his spouse could change the title a couple of years after the completion of the 1031 exchange by filing a quitclaim deed. But the main point here is that, excuse me, if Tommy sold the first property, Tommy should buy the new property. If two spouses are on title to the relinquished property, those two spouses can be on title to the replacement property without a problem. Now, here's another wrinkle. Sometimes a taxpayer owns a piece of investment property in an LLC. A single member LLC can be a disregarded entity. And what that means is, and you've seen this, right? Somebody owns their relinquished property in 123 Main Street LLC, but now they're buying 25 Oak Street, and they don't want to buy 25 Oak Street in the 123 Main Street LLC. Well, if both of those LLCs are single member LLCs, meaning, for example, Jillian is the sole member of that LLC, then she can sell from 123 Main Street LLC and she can buy in 25 Oak Street LLC because they're both disregarded, and ownership of those assets will still be reflected on her personal income tax return. The same thing would be true if she owned the relinquished property or wished to buy the replacement property in her living trust, sometimes also called a revocable trust. And there are also investors who own real estate inside an Illinois land trust. Now, for those of you outside of Illinois, you're probably saying, what the heck is that? If you're outside of Illinois, you'll probably never see it. But it's a unique mechanism that exists in Illinois and a couple of other states that use their own state names, but it's a way to hold real estate anonymously so that nobody knows who it is that really owns it. It's the ABC LLC, ABC Illinois Land Trust, and a bank is the administrator of the trust, and nobody can find out that Jillian is the mogul who owns all of Wacker Drive, for example. Okay,
Hey,
next
David,
slide. Yes, ma'am.
you got one question. I figured it would be good to answer it since it's regarding this slide. What if one spouse passes away and both names are on title?
Oh, okay, that's a good question. So, that actually has multiple layers to it. So, two spouses own property. It's an investment property. And spouse number one dies. Because it was a marital asset, it now vests entirely in the surviving spouse. But interestingly, the deceased spouse's portion, let's say it's 50, let's call it simple. Let's keep it real simple. Upon spouse number one's death, the property is worth $100,000. So the $50,000 interest that belonged to the deceased spouse gets a step up in basis. So now if the surviving spouse goes to sell the property, the only gain that they would have to recognize is on their half. They would still sell, obviously, the whole property. But I think the point of the question was, how does that deal with the same taxpayer rule? And it was in joint names, and spouse number one has died, and it can now be acquired entirely in spouse number two's name. Issues like that would require ultimately to get the taxpayer's CPA involved to verify what's going on with the taxes. But for our purposes, it does not impact the 1031 exchange. Thank you, Jillian. That was a good question. Jillian spoke about this, but I want to touch on it briefly. The statute says that the property must be held for business or investment use. But they don't ever tell us what that means. Business use, for example, would be if I have a landscaping business and this is where I park my backhoe and my lawnmower and all of that, that would be clearly business use. Investment use generally is thought to mean that it's a rental property and I have tenants in there and it's got cash flow. But I also have several clients who have bought raw land for the purpose of owning raw land. You might think that the state might want to come through here in the future and expand the highway, or the county might want to put in a school or something like that. But the property does not need to be cash flowing. Now, somebody just asked a question, how long do you need to hold the property? And that's where we get the holding period, because the statute says that it must be held for productive use in a trade or business. The short answer here is, let's look at the next bullet point. Buying a property to fix it up and flip it doesn't count. Okay? If we bought a property and our intent was to fix it up, polish it up, make it all shiny and new, and then resell it, that does not count. Okay, that was property bought for the purpose of resale. That is inventory. But there is no mandatory minimum period of time. Most advisors would suggest a couple of years, but I've had multiple transactions over the years where the holding period was less. Vacation homes and second homes also do not qualify for 1031 exchange treatment, but we are going to talk about that more on the next slide. So let's go there. I think it's on the next slide. Yeah, there we go. Oh, no, it's coming up. That's this. So if I own a vacation property and I want to do a 1031 exchange, if I am the exclusive user of that property, I've made no rental efforts, it won't qualify. But the IRS says that if I have a rental property and I also make personal use of the property, that may qualify if they'll first look at the relinquished property. That if I'm trying to do that with a relinquished property, right, I've held it for rental, but I've also used it. And they'll say, okay, David, in the previous 2 years, have you rented the property out for a minimum of 14 days? And have you limited your use to the property to either 14 days or 10% of the time it was rented, whichever is greater? And will you be doing that same thing with the replacement property? That is, in each of the next 2 years, renting it for a minimum of 14 days and limiting your personal use of the property to 14 days or 10% of the time it's rented. That becomes rather strict if somebody is looking to tap dance around the 1031 exchange rules so that they can buy their new vacation home at the beach, for example. So we caution people a lot about limiting their personal use of these properties. Next slide, if we will.
Hey, David, just because we got a question on it, can you also elaborate on converting an exchange property to a primary residence?
Okay, so taxpayer buys their replacement property in a 1031 exchange and they rent it out, and at some point in the future they want to move into it. Here there are multiple questions, one of which is, when we bought the replacement property, did we always intend to at some point in time move into it in the future? Because if we do, when the IRS figures that out, they could go back and disallow your 1031 exchange. However, if we bought the property as a replacement property in a 1031 exchange, and we rent it and we rent it and we rent it, and then something changes in my life, and now I want to move into it, and I tell the tenant, I'm not renewing your lease, and they move out of the property, that's probably going to be okay. But it should not be part of your immediate plans. As part of your 1031 exchange, you should not say, I'm going to buy that replacement property and I'm going to rent it for 2 years and a day, and then I'm going to move into it. 2 years is not a magic number, right? It comes up in a couple of places in the 1031 code, but it does not specify anywhere that you must hold a property for a minimum of 2 years. And when taxpayers say, I'm going to hold it for 2 years and a day and then move in, that's going to back them into a corner where they may not want to be. Very fact-sensitive question. Okay, we talked about fix and flip, so let's skip that slide. Jillian, I think you talked about allowable expenses a little bit, but these are the kinds of things, expenses that are being incurred specifically because it's a real estate transaction. Replacing the hot water heater is deferred maintenance. Replacing the roof is deferred maintenance. Those kinds of things that the home inspection says has to be done before you can close, that doesn't qualify for 1031 exchange treatment, right? Replacing the HVAC system, that's deferred maintenance, should have been done, isn't being done, or wasn't being done. So that would not counteract what needs to be reinvested on the next property. Next slide, if we will. Okay. I'm rushing because we're coming near the end, and I want to make sure we still have time for some additional questions. Everything we've spoken about so far today has contemplated that we're going to sell first and buy second. But there are times when you need to buy first and sell second. And this is what we call a parking exchange, what's called on the session on the street a reverse exchange. And what this means is that we can acquire the new property before we dispose of the old property. It's a little more cumbersome of a process. We have to go out and form an LLC on your behalf to take title to that property on your behalf using money that you lend to us to buy that property for you. You then have up to 180 days to complete the sale of the relinquished property. If you can't sell the relinquished property within 180 days, there's no taxable event, there's no penalty. You now own two properties instead of one. Similar to a reverse exchange is what is called an improvement exchange. If we sold a property for $500,000 and found one that we really like for $400,000, well, that's not going to satisfy our 1031 exchange rules of exchanging equal or up in value. I could certainly go out and buy a second property, but I could also use that additional $100,000 to make improvements to the property. And here I can use that $100,000 to replace the roof, to replace the HVAC system, to upgrade the kitchen and bathrooms, but it must be structured as an improvement exchange from the beginning. The relinquished property money will be dispersed towards the purchase of the property. We again will form an LLC to purchase the property on your behalf using your money. You will hire the contractors to make those improvements. And as each one submits an invoice, you'll sign off on the invoice. You'll forward it to us. We'll send them a wire to pay off their bill. And within 180 days or the completion of those improvements, we will transfer to you your property. So that's an improvement exchange. Next slide, if we will. This slide, I used to spend a lot of time talking about it before the election because it was part of the Democratic budget. But I do want to point out that every couple of years, somebody in Congress says, hey, 1031 exchanges are abusive. They favor the wealthy. The truth of the matter is that they stimulate business growth. The vast majority of 1031 exchange replacement properties ultimately have additional money reinvested into them. So we help revitalize neighborhoods. They create jobs. Believe it or not, they actually help family farmers as well. And something like 80% of all 1031 exchanges ultimately end in a taxable event, meaning grandpa sold before he died. So he now has to come back and recognize those taxes that Jillian mentioned at the beginning. And I think that leaves us still a few minutes for questions and answers.
Terrific. Well, thank you so much, Jillian and David. Really appreciate you guys going through this presentation and really educating us more on 1031 exchanges. There was just a couple more questions that we have. Oh, and thank you for adding the contact information. If you have any other questions that we don't get to today or have any specific situations, please feel free to reach out to Jillian or David, and they'll make sure to help guide you through the 1031 exchange process for your specific scenario. And then I think the only other question, and David, I'm not sure if you've had a ton of experience with this one, but do you know if any of the Illinois land trusts generally receive financing? And if so, if there's any specific financial institutions that do finance those?
I do not have a direct answer to that, but we could certainly likely find out.
Yeah, absolutely. And then just one other question that might end up going ahead and, oh, I think we have a couple others, but this next question is directed toward Jillian. Jillian, you talked a lot about the tax basis on a piece of property. Can you expand a little bit on what that basis is?
Yeah. Yeah, so basis is generally calculated using the original purchase price. So they would take the original purchase price of the property. They would add the value of any improvements that have been made over the time that the property was held, and they would subtract out depreciation taken over the time the property was held. That would give you what's called your adjusted tax basis. And you generally would want to subtract that number from the sale price to figure out your gain. But that's just an estimate. I would definitely recommend, following up with a CPA or tax advisor for exact numbers. And then also I did put mine and David's information in the comments. I put the incorrect information on the slides, so they are in the chat. If anyone would like to reach out to myself, you've got my email and my phone number, or David, you have his email and his phone number. And we're happy to answer any other questions that you might have.
Perfect. David, I'll leave you with this very last question that Frank asked in the chat. If the new incoming administration elects to either lower or increase the capital gains tax, do you think it would have an effect on the 2025 filing, or do you think it generally would be impacting 2026?
Yes. It's hard to say because there's some data that shows whether they raise capital gains taxes or lower capital gains taxes, there is a short-term blip in the revenue generated. I know that the Biden administration and the hopeful Harris administration had planned to raise capital gains taxes on the higher tax brackets. I don't know exactly the effect overall the 1031 exchange industry. I can't see the incoming administration doing a lot with capital gains taxes, candidly, but I'm not sure.
Thank you, David. And thank you again, everyone, for joining us today. Again, if you have any questions, please feel free to reach out to David or Jillian. We'd be happy to take care of you.
And I just want to thank all three of you for joining us today on behalf of all of us over here at RSU. And thank you to the audience for joining us as well.